Hello and welcome to the M&A Science Podcast. This podcast is part of a mission to rethink how M&A is done. The old school seller-led approach, it's dead. Buyer-led M&A is all about strategy, alignment, and efficiency, putting value creation at the center of every deal. And let's be real, it's not just about closing the deal, it's about making it successful. We uncover what truly works in M&A by learning directly from the best. I'm your host, Kisan Patel, founder and CEO at Deal Room and chief scientist at M&A Science. I'm joined by Marc Bell, a self-described deal junkie whose career spans from everything from newspapers and watches to satellites and data centers. He's taken 17 companies public, executed countless acquisitions, and built businesses across the globe. Marc brings a mix of grit, strategy, and creativity to M&A. He's not afraid to get his hands dirty in a turnaround. Today, we're going to dive into what it really takes to fix broken companies, how to structure deals using leverage and seller financing, and the principles that guide leadership and success. Marc, how you doing?
I'm doing great, and thank you for having me today.
Hey, thanks for making a stop to our M&A Science studio, hosted by VRC. If you're not familiar with them, valuation research company. I won't go anywhere else for valuation work. But can we kick things off a little bit about your background?
Sure. How far background do you want to go?
I had the entrepreneurial journey and like when M&A first got introduced to it.
Sure. So my background is a little off the beaten path as compared to others. Out of grad school, I started a company called Globix, which stood for the Global Internet Exchange, and that was in December of 1989. Over the next decade, we grew it into the world's largest logical peer, meaning we had 28,000 miles of fiber around the world, and we connected to more networks than anybody else. We became the second largest owner of internet data centers in the world. We had people like Walmart, Microsoft, and many, many others as our initial hosting clients in the mid-90s. And we went from just providing internet access to eventually web hosting, to eventually co-location, and then application development. What do you do when you get on the internet? Everything from video streaming to e-commerce. And I decided to sell in March of 2000. I was having kids and decided to sell right before my kids were born. And then after that, we went ahead and I moved to Florida. I set up a family home office. We started trading bonds. And one of the positions we held was a position in a company called General Media, which most people have never heard of. This was back in 2004, 2003, 2004. General Media was a company that owned Penthouse magazine, and owned by a guy named Bob Cuccione. They were in bankruptcy, and they were in bankruptcy. So we believed there was a lot of value there. We went through the process. Originally, we were just trading the bonds. We bought them at pennies on the dollar, expect to get paid off at confirmation. Guccione decided he was going to try to cram down the DIP loan. That means debtor in possession financing. You can't really do that in a bankruptcy court, but he found that out the hard way, and so we ended up foreclosing on the magazine. Next thing you know, we own a magazine with $30 million of revenue, losing $5 million a year. We tried to flip it, nobody wanted to buy it, and but we did learn a lot about day one. We at 9 a.m. on day one, we had about 200 employees. By 5 p.m. on day one, I think we had 50 employees, and the business still hummed. And we realized, because we spent a year diving into the business while we owned the bonds, to understand what they were doing right and what they were doing wrong. And this was a classic turnaround. Fast forward a decade later, we had done about $500+ million of acquisitions, put it into it, renamed the company Friend Finder Networks. We started a cable television network from scratch. We were in 330 million homes worldwide. Our websites had 700 million active users worldwide, and we were the 5th largest owner of email addresses in the world, besides Yahoo, Microsoft, Facebook, and Google. We took the company to about 350 million of revenue with 115 million of EBITDA, and then we ended up selling it to a hedge fund. So it was a very exciting journey. And while we were doing that, we got into, my partner and I did a SPAC called Enterprise Acquisition. In 2007, we had market. It was a $250 million SPAC. The market collapsed in 2009. We were left where everybody wanted their money back because that's how SPACs worked back then. So basically, we had a shell with $25 million in it. We turned it into what I believe is the world's first externally managed mortgage REIT. And with that, we started up a company which is today called Armor Residential REIT, which has over $15 billion of assets on the New York Stock Exchange. And it owns basically Fannie, Freddie, and Ginnie mortgages. And that's what we did. Is we realized there was a massive displacement in the mortgage marketplace when the market collapsed. And loans that were the principal was guaranteed by the full faith and credit of the U.S. government were trading way below par. And so we thought it was an opportune time to pick up yield and acquire some assets. And that company still exists today. Then a few years later, a friend of mine asked me if I wanted to go produce a Broadway show. I said no, and I said, if I really wanted to produce a Broadway show, I said really no, and I go, I'll do it on two conditions: one, I win a Tony Award, and two, I make money. And the joke on Broadway is, how do you make a small fortune on Broadway? You start with a big one. And our first show on Broadway was a show called Jersey Boys.
Wow.
And on I think it was a $12 million investment. We sold $1.6 billion of tickets worldwide. And I won a Tony Award. The show won a Grammy Award. We got a gold record, a platinum record. And then my partners asked me if I wanted to do a play. And I'm like, and I'll be honest, I'm a big fan of Broadway. But okay, so we did a play called August Osage County. It won a Pulitzer Prize. I won my second Tony Award. And then we made a movie with Jersey Boys. Clint Eastwood directed it. We made a movie with August Osage County, and Meryl Streep starred in it. And then we just kept going. And we did Rock of Ages, which was awesome because we made a movie with Tom Cruise, and that was a lot of fun. And I got a chance to be in the movie. That was a real lot of fun. And though nobody could recognize me, I had long red hair and Arsenal. I was a groupie. It was pretty funny, but it was fun. And then we went on to do, in the end of the day, we probably sold over $3 billion of tickets on Broadway worldwide. Broadway, the road shows, and stuff around the world. And then we started investing in hospitality. We invested in a restaurant in New York called Lavo, called Catch, a nightclub called Avenue, a pizza chain called Arbitrage Brazil Pizza. We did Bongos in Miami, Philippe Chow in Miami, and numerous other restaurants just because it was, we didn't like waiting for tables. So it seemed like a good idea. And we got very lucky. We had great partners. So we were very blessed. We were really good operators who helped work with us. And then lately, then we went into, we bought a small company called Tyvek, which I invented the CubeSat, and turned that into Terran Orbital, and recently sold that to Lockheed Martin. And now we're looking for what's next. Keep going.
Yeah. No end in sight.
No end in sight.
Are you the definition of like an opportunistic investor?
I like to think of myself as a serial entrepreneur, but I also try to be smart in how we operate our businesses. So a great example was I was building data centers in New York City. We built them in New York City and London and California. And I went and I decided you have to own your own real estate because you spend a lot of money putting a data center in. So we were acquiring a building, 415 Greenwich Street in New York. And I forgot the gentleman's name who sold it to me. Super nice guy. And we paid $25 million for the building back. And then we're talking back, 25 years ago. And it's a whole city block. And he goes, and he tells me how super nice guy, was probably in my early 30s. And he invites me up to his office after the closing. And he goes, Mark, I really, I feel bad for you. You overpaid by about $5 million for the building, and it was only worth like 20. So I want to take you under my arm, and I want to teach you about real estate in New York and how I can help you do better. And I go, sir, I really appreciate your offer. It was very kind of you. But, I paid $25 million because there were $18 million of historical tax credits on the building, which I sold to Chevron the next day after closing. So I really only paid $7 million for your building. And he goes, what historical tax credits? The ones that date back 50 years that were just you didn't, for whatever reason, you didn't take them. He goes, huh? But if you like, I'll take you under my wing and teach you about real estate in New York City. And it was very funny. So that was an opportunity, and we continue to look for opportunities when we buy real estate. And we look for real estate that has clauses and stuff that date back long before most people were born and that work on the projects. And we're very lucky to keep finding real estate around the country that is unique and that we can buy for a significant discount.
It's still opportunistic.
I guess it's opportunistic. It's entrepreneurial.
I'm curious because it sounded like early in your journey you built a business from scratch. Mm-hmm. And now if you look at things, it sounds like you're more of a theme of finding things that you can be creative and reposition or something unique.
Well, now I'm looking for building more businesses from scratch. So we built a broker dealer from scratch at Armor Capital called Buckler, which has done phenomenally well. We're looking now at other things that we could build from scratch. We've been looking at trying to build a small nuclear SMR, small modular reactor business. All these data centers around the country are popping up, but they need power. And there's going to be with AI and the massive amount of data processing that's needed, there's just not enough electricity. And small modular reactors could be a very cost-effective way to do it. And so we're looking at how we can produce these in mass production, not just producing these as one-offs, producing these in mass production. We're also looking currently starting our first fund. We've never had a fund. And so if you're 57 years old, it's not too late to do something new in life. So we're starting a national security fund with an AI focus, really focusing on acquiring, investing in companies that serve the national security of this country, but using AI to achieve that mission. And so we'll be going on the road with that soon, and we're pretty excited about it. This is not a solicitation offer, by the way. And then we are. I'm sure the other exciting things that we're working on. We're looking at other companies that we could acquire and do turnarounds as well. And so it's we keep finding interesting things and interesting businesses that could use help.
Is there anything that draws you? That's what I was curious about. They're sort of like building from scratch, and I think you were spot on in terms of like there's a significant market opportunity and there's nothing that exists, which builds your case to build, versus the flip side of buy. Like what sort of drives you to sort of really get something that catches your eye that makes it worth buying?
It has to be something either I like, I enjoy. I don't want to do it just for the sake of making money. It has to be something. So I got my master's degree in real estate development and investment from NYU. So I love real estate. Love building things. I've always loved building things as a kid. So building stuff is fun. But it has to be a business that I feel like I could really get my arms around and really not only understand, but something I'd be like, wow, that's fun. So for example, I purchased a company, called Kibu. It was a Dutch watch manufacturer. They had 2 stores, one in The Hague, one in Saint-Tropez. They made a great, huge 55 millimeter watch in a lot of colors. They were going bust, and I loved it. So I decided to acquire the company. And over the next few years, we went from 2 stores, and we were in 6,000 retail stores worldwide. And we sold 2.5 million watches. And we were on the main runway at New York Fashion Week. We were having a blast. And then, unfortunately, COVID happened. And the watch company, unfortunately, did not survive. But, we learned our lessons, avoid plagues and manufacture stuff locally in America. So, we learned a lot of lessons there. But it was a lot of fun while we were doing it. Teach me that. Like, how do you even spot these kind of turnaround opportunities? Like, what's your approach to like diligencing it and know you're avoiding a trap of catching a falling knife that's keep falling? You look at business. We look at businesses that a lot of stuff just falls in our laps. General Media fell in our laps because Bob Guccione was one of Globix's first customers. So he called us asking for help in the bankruptcy. So we said we would help. And then we said, that way he would get his magazine back. And in the end, he turned against us, and that's we ended up owning it. But we had never had any intentions of owning it. We were just trading bonds. And so that kind of fell in our laps. With the watch company, it was more of, I didn't want them going out of business. I loved wearing the watches. All my friends were like, wow, that's so cool. They had hundreds of different colors. It was just fun. And it was very little. It cost us very little money to buy it, and it cost us some money to turn it around. But it was it was on a great trajectory until COVID, unfortunately. And then other things that we've done, and then other things we start from scratch. We just kind of, get ideas and we build it, and we just kind of fall into things.
Opportunities multipliers are seized.
Yeah,
you sort of get this reputation. People are like, you should go call Marc. Maybe he can.
You'd be surprised. People call me all the time, and sometimes I'm like, "Oh my God, that's so cool!" And I want to get involved. Like I got a call once from a venture capital firm that was investing in a disappearing tattoo company in Canada. They couldn't for their fund structure, they realized would prohibit them from doing a Canadian investment. So they called me up, and I'm not a fan of tattoos, I admit it. And so they asked me if I would be willing to take over their commitment to invest. And I go, hell yeah. And because it solves a problem, tattoos that disappear. I like that. And so I went and invested in this company and, tried to help them grow. And we grew it. And eventually I sold it. I sold out. And it was just a great example. It was a young entrepreneur. And I was able to work with him to give him ideas on how to grow, and he grew. It's a great product.
How do you mentioned you haven't done a structured fund? How do you think about capital structure?
You always want to be the senior secured lender at the end of the day, and go from there. You want to be at the top of the cap table whenever possible. But that said, we are you try to layer it. We always do equity, then we do preferreds, then we do debt. And you always try to layer in all the different parts of a cap table that makes sense. It depends on the business.
Yeah, that's true. I'm just wondering, like, what is your alternative structures if you're not raising money? If you're not, I guess, like, what are your levers that you're pulling on? And I'm trying to get your lessons over time of like, hey, here's what I learned. If it's going to be a new startup from scratch versus buying something that's a turnaround situation. What are sort of the way you would architect the capital structure to make sure you're...
Well, I mean, one, we never want to work for the lenders. In other words, you want to make sure you're only borrowing what you can afford. So if you're not EBITDA positive, you don't have free cash flow, you better have a plan on how you're going to get there. Because then the lenders will own the business. Two, we never like to work for the landlord. So we always want to own the real estate where we are. So we try very hard when we're growing businesses to own the real estate when possible. We believe owning the real estate is key. Because eventually, you pay off your mortgage and your rent becomes cheap, and rent, it comes, look at New York City. Still your rents are still sky high, even though half the city seems to be vacant. But, San Francisco is getting, you're seeing now a massive change where, buildings are selling for, 30 cents on the dollar, 40 cents on the dollar, because nobody wants to be in San Francisco. And people are getting great buys, buying amazing buildings for very little money. And we always joke the second owner of a restaurant always makes money. The first owner spends too much building out the restaurant, and then when the landlord relets it to the second owner, all the kitchen's already built out and everything's already there, and it's turnkey.
Right, you're going to right size the value of it and then optimize the operations, yep. And it's a lot easier to fix something versus build something.
Sometimes depends what you're doing.
You're right. It's not in one size fits all, I guess, in that vein. So we have, if a business is cash flow, that's always a good thing to leverage, but it's got to be serviceable.
Right. Well, how does an entrepreneur spell happiness? Positive cash flow.
I like that.
I learned that from an undergraduate. I went to Babson College, and they teach you that the first week in school. That's an orientation event.
What about businesses that aren't cash flowing? What is your view on how do you structure those deals?
That's harder. They're not cash flowing. We try, as I get older, I get more risk adverse. So when I was younger, absolutely, I would jump on in. We'll try to figure it out. Now at 57 years old, I like much more guaranteed, much more secure, much more conservative human. I try to take less risks.
I'm trying to wrap my head around this. Like I play in software, right? And I got like, I don't think I'm going to do another thing from scratch again. I'm like done with that. But buying, fixing things, sure. Like those are interesting. When I look at opportunities for us to acquire other businesses, they're adjacent or in the same field in software, and they're not making money and they don't have growth, but they still have really high value expectations. So can you teach me, how do you sort of, sort of bridge the bid-ask spread or really like help the seller rationalize the valuation expectations? And then the other part is even just structuring those deals, because that's stuff you really don't want to put debt on.
It's funny. I meet lots of people, lots of entrepreneurs all the time, and I always hear the expression, I used to do a lot of venture investing, and I'm building a company to take it public. That's the one probably I've heard the most. Yep. And then I remind them that there's a 1 in 3.2 million chance of their company going public, and there's a 1 in 770,000 chance of them getting struck by lightning. So I say, go home, get struck by lightning, come back, and because that's not how you start a business. And you don't say you're not starting a business knowing what your exit's going to be on day one, because what is it? 168 companies went public last year. That's it. 200 so many companies are going to go public this year, maybe. And not this is the way we're going, probably not. And you're talking about, but yes, there are millions and millions and millions of companies all over the country. So it's people have very unrealistic expectations, and it's unfortunate because I see a lot of businesses fail. 80% of all new businesses fail within the first year. In this 2 years, 2 to 5, another 80% will fail, and what's left, 50% will fail. So very few succeed. And a lot of it, unfortunately, is because of, I don't know if the right word is hubris, I don't know what the right word is, of founders who just believe their thing is the best, it's the most awesome thing in the world, and they're worth the most amount of money. And they end up getting nothing at the end of the day. And that's unfortunate, because they probably could have been good businesses if they were realistic at what they had and realistic in what the value was, and they could have raised capital. And being realistic with yourself is the key. We never kid ourselves.
Yeah, because I can see that. Like, this is the cliche thing that you raise too much money at a too high of a valuation. You don't make up the metrics that get the return back on that valuation, and then you're underwater, and then you're in trouble.
Right. Yeah, I mean, it's all about being. I find with as you get older, you get more conservative and you're realistic about how things go and what your expectations, setting your expectations properly. So we go into a business now and we set very low expectations. And it's like Scotty from Star Trek, always set very low expectations and always exceeded them. And that was his joke. And so we always want to set low expectations and exceed them.
I totally agree. It feels better. You sleep better at night.
Sleep much better at night.
So how do you do that? I feel like we're in this environment where now we got all the AIs trending, and you look at the valuation on those companies, and it's even, you thought we corrected ourselves after 21, but no, it's like swinging back the other way again.
I always talk about, the being first doesn't mean you're the best, doesn't mean you're the winner. If that were the case, MySpace would have been a winner. Lycos would have been a winner. There's a long list of people that, had the right idea early, but didn't become a winner. Later, the people who came later on were the winners. And so we have to, AI, quantum computing, there are going to be winners, and there are going to be a lot of losers. And nobody knows who's going to be who.
Yeah, that's a fair point. Is there, I guess, anything that you, in terms of like, I'm just thinking managing risk, right? To keep out of that sort of realm of overvaluation, keeping it, like we talked about, just real achievable. How do you discipline yourself to do that? Like, is it just all the numbers and saying, all right, we have a high level of confidence, we can hit this? Is that what it is, or is there more to it?
We look at the numbers, but we also believe you bet on the jockey, not on the horse. So we look at who the operators are. Some people are very, very smart. And smart doesn't necessarily mean you have your PhD. They can be street smart. They can be other kinds of smart out there. We look at their backgrounds, their track records, and all the times I met a young man the other day who I just hired, who's 30 years old, and I believe he will do great things. But he's got to get comfortable with making decisions and getting comfortable with risk. But you meet someone after you become a good judge of character. So you feel like who's going to be the jockeys of the future, and he'll be a great jockey 10 years from now.
Tell me more. What makes a good jockey?
It's a good jockey. People who are realistic, people who ask great questions. So I love when people ask questions.
Yeah.
Because if they ask smart questions, that means they really thought about it. Ask thoughtful questions. People love. Well, on one hand, people just love to speak and pump up themselves, but you notice that when you meet people and they ask lots of questions, you have to learn about them by the questions they're asking you. So whenever I interview somebody, I like when they ask a lot of questions, and the more sophisticated the questions, the more detailed the questions, I like that, and I'll push back, and I'll see how they take it, and I want them, because I want them to feel self-confidence, and I want them to be I push back for them to argue back. What's their point? And but it can be on any range of, even doesn't have to be issues related to the job. It could be about politics. It could be about we had a great banter with people the other day over the Trump administration and Harvard and docking them $8 billion for Harvard for the way they treated Jews during all the anti-Semitic things. And you know what? Listen, I think it's great that the administration is focusing on as a Jew, focusing on anti-Semitism. I think, schools like Columbia should be punished, don't get me wrong. But I also think the research, especially the medical research like Harvard does, that shouldn't be punished. They should punish them in appropriate ways. But I do think, punishing them makes a statement. But the cutting out medical research that helps the entire nation probably isn't what we want to see, because that also creates innovation and that creates other things. And you want to, there's a balance between it all. And there's a balance on how you do things.
I like this. So vetting out the best jockey, it's like seeing how the questions are asking some smart questions. The ego part, like making sure they're not too focused on themselves. They got a big ego. And then the banter part, you turn around and challenge it a little bit to see how they respond with some banter.
And how they react to it. I know I'm in PA. I don't belong to a political party. Never have, never will. But the banter you get with people is, because I couldn't care less who's president. I care that the president's doing the right thing, and I care that we have a budget that needs to get balanced. Clinton had a balanced budget. Everybody forgets he's the last president to balance the budget. No Democrat or Republican has done it since. You need a balanced budget. You need to look at the deficit. We went from a $4 trillion deficit to a $30 trillion deficit. Our kids have to pay that off. And why leave our kids? It's $160,000 per person or something like that. Maybe the math wrong, but I believe it's $100. I know it's over $100,000 per person. So if you want to go write a check to the U.S. government of $100,000 and pay down your deficit, you can have a reduction in your income taxes, and that'd be a great concept to get people to pay off their share. But it's not. People don't realize that they have all this debt accruing that they own a piece of.
Yeah, that's a good view and a good thing to banter on.
Yeah, but you think about it, we pay off the national debt, pay off, all of a sudden, taxes will go down, the economy will soar. I mean, countries like China have no national debt. Russia, I don't think has any national debt. And, the Emiratis, the Saudis have no debt. And they're doing okay for an economy.
It's a good goal to strive for. You said earlier that these deals tend to find you. And I'm a big proponent of a buyer-led approach where you got a profile, you got a strategy, and you're very proactive to find those opportunities, as opposed to bankers and third parties just bringing you stuff and then you're trying to rationalize your strategy around it. What's your view on that, of being proactive? And
I think being proactive is great. I joke, I do the cocktail party circuit all the time for all the conferences, because you meet people and you talk to people and you never know what's going to fall into your lap. Or people tell you, I'm trying to raise money for this or that. And then you try to look into it and say, okay, does it make sense? How can we improve it? The trick is, how do you make 1 + 1 = 3? You give people money, that's great. But how do you give them more than money? How do you give them knowledge? How do you give them advice? How do you get them customers? How do you cut their costs? How do you do something that's going to be transformative for their business? Not just write a check, but truly be transformative to the business you're investing in.
How do you do that?
Well, that's just experience.
Well, I know what I'm asking, because it's so easy to screw that up. It's so easy to bet on the wrong jockey. It's so easy. And I get the experience point. I'm just...
My partner once said to me, I have a 500 batting average. And I'm not a baseball fan. I go, what does that mean? He goes, Mark, it means 1 every 2 things you touch turns to shit. I'm like, that's great.
That sounds pretty good. Yeah.
And I'm like, but he goes, but a 500 batting average still puts you in the Cooperstown Hall of Fame. And I'm like, where's Cooperstown? He started laughing. And I'm not a sports guy, but he explained it afterwards. But, as you get older, I try to improve my batting average. My batting average is much better today than it was 30 years ago. And so I continue to improve my average.
Any other things besides the jockey part, right? You got a good vibe. This person's the right person that's going to follow through. Any other elements that you look for in a good deal?
Well, we look at the total addressable market. We look at the
TAM. Yep.
We look at the TAM. We look at who are the customers, what's the value of that customer, what are the chances that customer is going to buy again, if it's a recurring revenue item, or if it's a hard good item. But there are things that can and should be done to really analyze the business.
I guess I was thinking on the strategy part. It sounds like, once you sort of find a direction with this business, you got the jockey lined, and then you're looking at some of the elements, the TAM and things like that. Then from there, that's when you could be very pragmatic about what are the other businesses that may align or you want to acquire with it. Does that sound right? Or is it still, and I'm trying to think of when do you get to that point when you're really proactive on, we have a strategy, this is what we need to do. We need to go acquire these other assets. Is that sort of...
Well, when you look at a company, a lot of times we believe if you control your supply chain, you control your destiny. So with any company we acquire, we try to make sure that they have always deep control of their supply chain. And whatever that means for that company, we want to be able to control the supply chain.
So that's part. I guess that's a good lead in. It's okay, you look at this company, and then when you think about how do you make that sort of vision or the strategy from it, that's one good philosophy. It's you control supply chain, and then that gives you a view of does it M&A sort of fit in to be able to achieve that, or
right.
Are there other means to do that?
Controlling your supply chain is key, because then if you own your supply chain, you have you can have better control the quality of your product, better control the cost of your product. It's all, pretty much all good things come from that. People, they taught you in business school about, just in time, right? Yeah, but the reality is it doesn't work. I mean, companies keep having supply chain problems, and just in time inventory isn't working. But people who own their supply chains, back like Ford in the 1920s, they owned their supply chain. They owned everything, and it worked. And I believe that's what's going to happen now. Everybody who's building stuff in China today is going to go ahead and be like, wow, we were screwed. We have all these tariffs. If we would have built it here in the U.S. and owned the factory, it would have been a lot better.
Yeah, those would be the manufacturers get ahead, the niche domestic manufacturers, because they own their supply chain. What's a good another Marc philosophy from bet the right jockey here, own your supply chain, and any other good
buy low, sell high.
Buy low, sell high. Yes.
That's a good one.
I try to teach that to my kids. Guys, it's not that complicated. Just buy low, sell high.
Everything else, I don't know. I haven't thought about it too much. It's just things that come to mind. I always tell my employees, don't be afraid of making mistakes, and be afraid of making bad. Not making a decision is worse than making a bad decision, because if you don't, you get a paralysis by analysis, and people are just afraid to make decisions. And I see this at big companies all the time. People are afraid. They want to make a group decision so nobody can take personal liability for the decision. And everyone's afraid of making a bad decision. I'm like, what? Make a bad decision. It's okay. And, it's not the end of the world, hopefully. And we will, but more importantly, we learn from bad mistakes. Everybody learns from their mistakes.
I feel like the cliche corporate thing is you're encouraging an entrepreneurial culture when you hear what you're describing is go take some bets, go do something.
But big companies, I've seen it over and over again. Big companies don't want their employees, or if they don't want to take chances. They know they got a job, as long as they keep their head down, no one notices who they are. They get the 35 years and they get their pension and they move on.
Yeah,
but there's no efficiency there. There's no moving the ball down the field there.
So the strategy part can come up pretty easily, right? You can sit there in a room, hack out some ideas, finding the right jockeys to bet on. That takes some work. You got to go meet people and hit the conference circuits and so forth. Some of this ways to create value, the actual execution. Once you get the deal done, and this is something you've done really well, is that you make things happen. And I get it. The right people always matter. But is there anything else that you're doing to either align incentives or just certain structures that you found have really helped push some tailwind to make sure that things get executed and there's some success that happens?
Well, we try to tie people's compensation to performance metrics, which will lead us to success. So we want people to have skin in the game. Everybody wants to make money. I've never met an employee who says, I want to get paid less money. Everybody wants to make more money. Fine. Let's give them a way to make more money. But they have to be successful. So let's incentivize them to make more money.
Give me some examples.
We have a manufacturing business, and we had a deadline we had to meet. It was a tight deadline. People had to work double shifts, And we said, look, we have a pool of money. We're going to pay out $1 million to everybody working on it. It was like 150 people, and we're going to divvy it up. And as long as you keep working your double shifts 7 days a week till we make the delivery, you get to share in it. Some people dropped out, others stayed in. But every day that it goes by, the pool decreases by $10,000. And so the pool eventually would dwindle. I think it was 10. I maybe have my numbers wrong, but the pool dwindled down. So at the end of the day, if you missed all the deadlines, you get nothing.
Wow.
And so people had a real incentive to go ahead and help each other because it had to be a team effort. It was all or nothing. And so everybody had to help each other. So it created a lot of teamwork, and people won their bonus.
I like that. I think that's like a key factor.
It was great.
There's a financial incentive that
but it was a financial incentive to both encourage everybody to work together, because if the person next to you was getting it wrong, that means you wouldn't be able to deliver the product, and everybody suffers. So everybody was forced to help everybody else. It was really very. I was very pleased with how it really worked out. It created a lot of bonding, and that was really good.
How important is that to just making sure you got the right person in?
Well, people have to, what are current, is it not Gen Xers, millennials? What are they called today?
Gen Zs.
Gen Zs. Yeah. Gen Zs have a real problem. And because Gen Zs, they're stuck with their phone in their hands, and they don't know how to communicate. They don't know how to work in teams. And they're very much, want to just work from home and work I'd be like, I basically tell them all to go back to whatever barista they came from, and grow up and come back when you want a job.
They're not incentivized by money. They're trying to get their Snap score up and collect some Robux.
Yeah.
So
I think social media has not helped us.
So that's one to overcome. But maybe we get to that point. You got to have some real bills to pay. I don't know.
I don't know. I wish that was the case. I haven't seen it yet.
We talked before, and you had this term you used about taking people out of the process. Can you tell me more about that? It was related to automation, and I think we're talking around scaling.
Yeah, I mean, listen, computers don't make mistakes. People make mistakes. So, the more we can automate things and use AI to help make sure that to teach the robots to be better with their jobs. But we're creating new jobs in terms of programmers for AI, people who build the robots physically until robots build robots. And I guess you have Skynet at the end of the day. And, we are very much, all about, robotics is a huge way to save money and do things fast and quick and get it right.
Any trade-offs between, over automating, trying to focus on innovation, but still maintaining the human touch?
No, I think you always have the human, because humans are the ones programming the robots. So humans are the ones designing everything. So it has the human touch. But once again, you try to solder something, your hand can't stay steady over and over again 1,000 times for solder. A computer can solder things 1 billion times over with never slowing down.